Welcome to Talk Tickers. So TD Bank just dropped its third quarter earnings, and at first glance, they looked absolutely fantastic. But here's the thing. While the earnings report was glowing, the stock chart, well, it was bleeding. This is what we're calling TD's Great Disconnect, and we are going to break down exactly why.
Okay, let's just dive right into this mismatch. On one hand, you have TD posting a strong adjusted EPS, blowing past what analysts expected. Revenue also came in hot. But on the other hand, the market just hammered the stock, sending it down a painful 4.5% on some pretty significant volume. So what in the world is going on here? What is the market seeing that the big, shiny headline numbers are missing? Why are investors so skeptical when everything looked this good on paper? Let's unpack it. All right, let's get into the results and see how this all builds, starting with that really solid top-line performance. And I mean, on the surface, you really couldn't ask for much better. A clearer earnings beat, a revenue beat, and their provisions for credit losses, that's the money they set aside for bad loans, that came in way lower than anyone feared. Plus, their capital position, that key CET1 ratio, is rock solid. This should have been a great day for the stock. But once you start digging into the bank's different parts, you find the first big clue. The Canadian business, their wealth and insurance arm, wholesale banking, they are all firing on all cylinders. I mean, look at that 63% jump in wealth. But then, your eyes go right to that glaring red number. U.S. retail net income is down a massive 18% from last year. And that is the weak link. And the answer to the market's really negative reaction, it lies squarely in that U.S. business. It's got two major problems hanging over it: huge remediation costs and a forced restructuring. So after getting hit with over $3 billion in penalties for failures in their anti-money laundering systems, TD is on a very long road to recovery. And this timeline, it shows you this is not a quick fix. They expect to get most of their own stuff done by the end of 2025, but the really crucial part, the regulatory monitoring and testing, that's going to stretch well into 2027. And this isn't just speculation. Management confirmed it directly on the earnings call. The U.S. CEO, Leo Salem, came right out and set expectations for a prolonged period of heavy spending and intense regulatory oversight. You can bet the market heard that message loud and clear. And the cost of this whole cleanup, it's just staggering. The bank is basically telling us to expect $500 million in pre-tax AML costs this fiscal year, and then a similar amount again next year. That's $1 billion drag on earnings that the market is now fully pricing in. On top of all those costs, regulators have put a cap on their U.S. assets, basically putting them in a penalty box. To comply, TD has to actively shrink its U.S. balance sheet. They've already shed tens of billions, and they've got another $18 billion in loans to get rid of. This means instead of growing, their U.S. loan book will actually be contracting until late 2026. Okay, so let's try to put all this together. Let's contrast the core strengths of this bank with those really persistent challenges they're facing down in the U.S. The bank is really in a clear tug-of-war with itself. On one side, you've got these powerhouse Canadian franchises just putting up record numbers. I mean, truly exceptional performance. But on the other side, they're fighting against this huge drag from the U.S. cleanup, that $500 million a year expense, the shrinking loan book, and now new restructuring charges. Now, management's tone on the call was very bullish. They focused on the strength of their core businesses. The group CEO, Raymond Chung, kept highlighting their momentum. But the market? Well, the market just isn't listening to that right now. It is focused entirely on the cost and the long, uncertain timeline of this U.S. turnaround. So, where does all of this leave investors? Let's move to our final analysis and talk about what we're going to be watching for on the next call. So what this all boils down to is that the whole investment narrative for TD has completely shifted. The story isn't about Canadian strength anymore. It's all about discounting for American uncertainty. Right now, the market is basically pricing in a worst-case scenario for this U.S. cleanup. So, with that in mind, looking ahead, here's a plausible way to think about it. First, the premise. All this bad news, the costs, the runoff, it's likely already baked into the stock price by now. So, what's the catalyst to watch for? Well, the stock could get a real boost on any sign that the U.S. cleanup is going better than these very low expectations. If costs come in lower or they make faster progress with regulators, the stock could move higher. This creates a pretty balanced risk-reward profile from here. And for that reason, we are initiating coverage with a market perform rating.
Look, those powerhouse Canadian operations provide a really solid floor for the stock, but that U.S. overhang creates a ceiling, at least until there's more clarity. So the key question for next quarter is this: can management give us any sign that that ceiling is about to get higher sooner than anyone expects?
This is not financial advice.